Hey everybody, this is Jose. We are about to get started. As we are ready to begin, I'd love to have a quick hello on the chat box if that's possible. That would tell me that you hear me. So not only you're ready to begin, but that sound is good too. So that way we are ready to start. Thank you thank you so much. Thank you so much, Ahmed. Very nice. We have 40 seconds to go and we start. Mark, how are you? Anil, good to see you, my friend. Very nice, everyone. Almost ready to get started. Okay, so it's almost there. Here we go, top of the hour, time to get started. Everybody, welcome to the session. Today is Aug-4, 2022. My name is Jose Blasco, and this is Options Trading Live. We're going to be looking at the options markets, looking for market opportunities. Beyond market opportunities, we'll be also reviewing trades that we have and discussing it all. As always, as we start the session, I am highlighting the financial disclaimer on the upper left side of your screen. Please read it carefully. This is important information. I always point at the fact that it's fairly short. Therefore, I'm counting on you all to read it completely. Thank you very much. How are you, Jeff? Good to see you, Jeff. Very nice. Cool. So the plan for today, we look at the markets, understand the environment. We look at trades that we may have. We talk about what to do with them, if anything needs to be done from a management point of view. And from there, we talk about finding new opportunities and planning those trades, explaining how we plan them, why we're planning this way, assess the risk, etc., and finally executing those trades. Okay, so let's begin. A quick highlight of what I normally call the questions page. Not that this is the title of the page, but we often call it the questions page. tradewithufos.com/Jose. Why do we call it the questions page? Because when you scroll down all the way to the bottom, so here is the question section where you could search for answers, or if you don't find the answer, you can then click on the green button, type your questions, and you'll get answers. Okay, very good. And with that, all of that said, it's now time to begin our analysis. We'll start with looking at the broad markets. We normally use the S&P for that, and we will begin our market analysis that will dictate not only what's happening in the market, but most importantly, what type of trades are we looking for in today's session. So where are we at? Okay, well, we are the S&P is showing us a blue climate. Okay, it's a thick dot, so the climate is confirmed to be up, and this climate has been running for 6 days, where statistics suggest 5 is a normal thing to happen. So in other words, the duration of this climate is now surpassing a 1 standard deviation normal duration, and therefore we are now stepping into the less likely territory for the S&P to continue being blue instead of changing to red. On top of that, when looking at the max distance, we can see that a 2 standard deviation of what we call max distance, or often I refer to as too far too fast, is 0.77. We've reached, as the market has been progressing higher, and these are the guilty candles, if you wish, we've reached that huge, massive extension, has brought in the maximum extension right here, okay, to be 1.73, which is way more than 0.77. So if 0.77 is 2 standard deviations, 1.73 is almost 5 standard deviations. In other words, we could certainly call this way too far, way too fast. So both from an extension or max distance point of view, as well as from a duration point of view, we are in both cases pointing at a market condition which is statistically unsustainable and should reverse sooner than later. Now, there is a very, very big indication here in the bottom part, which we talked about last week, isn't it? Where the blue line is above the gray line. So for the ones of you new to the sessions, what is the blue line? The blue line is the implied volatility of the calls. What is the gray line? It's the implied volatility of the puts. So what happens when the call volatility is higher than the put volatility? Well, only two things could happen for this to be the case. Option one, more people are buying calls, or more people are selling puts, or both. If more people are buying calls than puts, the blue line will go above the gray. If more people are selling more puts than calls, then the gray line will go below the blue. So we don't know if it's the first case or the second case or a combination of both, but in both cases, the conclusion is we have buyers in the market. Why? Because buying calls or selling puts, which is what makes the blue line to be above, both buying calls or selling puts, it's a bullish thing to be done. And therefore, we have buyers in the market. Okay. And this is probably why, while this move, statistically speaking, it's statistically unsustainable, the market is fighting it. Okay. The market is fighting it. We've seen a few classical reversal candles you would expect, out of those, indecision candles to have a continuation to the downside. If you are looking at the markets from a purely classical technical analysis point of view. But guess what? No, it didn't happen. Another strong move the day after. So again, why is that? It's because there are buyers in the market, and we can see that in the options markets very clearly. Okay. Having said that, those buyers in the market are probably thinking, hey, should we take some profits? Because again, the size, the duration and the size of this move, again, went beyond what probabilities suggest, and probably this profit taking that should be happening will bring this climate to be back to red, based on statistics for 3 days, so not the end of the world, and then back to blue, especially if we have a condition where the blue line remains above the gray, which means that the buyers are still in the market, they took profits and they are ready to buy again. Then we're gonna have a continuation, and this trend will continue developing. But again, I would not be betting like I did the other day. I would not be betting aggressively on being directionally long in this market environment, given everything I just explained. That yes, we do have buyers in the market, but right now the S&P, it's overextended, it's statistically unsustainable, and betting on more of movement to the upside, while it could happen, it's what I would call hopeful, because we need a bit of luck for this to happen, because it's not a normal move. It's a move that is not behaving like statistics would suggest. Okay, so in other words, non-directional trading is going to be my preferred approach to trading today. If I was to be very aggressive directionally, I could even look for shorts. I am not that aggressive, so I'll prefer to stay on the safe side with non-directional trades. And what kind of non-directional trades? Well, when looking at the VIX and putting on the side that all stocks got their own implied volatility, and we may find high volatility when the VIX is low and vice versa. Well, the VIX is currently trading at 22, and I don't mean to give a value or a meaning to the value 22, but more to the picture that we have on the chart, where the highest values are out here and the lowest value we got on the chart is right here. So obviously the VIX is not a high value as we speak, right? It's not a high value. If we go back to the S&P and I look at the volatility range, right? So we are pretty low, in this set of ranges, in that gray area, if you wish. We are in the bottom part, not in the very, very, very bottom part, but certainly not even in the middle. Okay, and definitely not high. So in other words, premiums are low across the board, and you guys tell me on the chat box, okay, if that's okay. When premiums are low across the board and I shoot for non-directional opportunities, what type of strategy is the strategy that you've seen me multiple times employ? Love to see you guys type this on the chat box. Okay, that would be great. Go for it, my friends. I'll wait a second to get that answer, okay? And in the meantime, the next step that we're going to do before we start looking for those trades is to review the positions that we have. Okay, so we'll start with that. The double diagonal, Mark, you are right, even though probably you meant to say the double calendar, isn't it? Joe, calendar spreads could be a valid way to approach it. Double calendars, which is what I normally do, would give us a wider range to play with, but certainly calendars could be another way to approach it. And also, Anil, diagonals certainly is a good strategy for when volatility is low, but a diagonal spread makes you directional. And given the fact that the S&P is where it is, at least given my trading plan rules and everything I just explained, I would prefer to avoid being directional. Therefore, the double calendar will be my choice for today. Okay. Cool. Now, when reviewing trades, we have the Twitter trade here, which this one concluded. And I think we said everything that needed to be said about this trade. We did a few tweaks. If we had done nothing to this trade, we would have lost 198 because we kept working on massaging this trade while the market was moving against us. We ended up creating a net result of $87 of loss per contract, which obviously is a losing trade. But hey, we basically reduced the risk by half. Okay, so good job there, even though it was not the desired outcome, which happens, in trading. It happens often that sometimes we get losses, right? So not a surprise. The other trade that we have running here is a trade with Micron. This is a bull put spread. It's a credit spread, but it was built in a way that it was, somehow quite directional. And so let's take a look at the chart. It's making, as you can see here, let me look at the midpoint. So yeah, the midpoint point at $25 of profit. So this trade is reporting some profit as we speak. Let's take a look at the chart and let's discuss if anything needs to be done from a trade management point of view. Okay. So what do we have? Well, this is when we started the trade. Okay, right there that day. Okay, which is last week. So as we started the trade, the next day went a little lower, the next day a little higher, the next day a little lower. Finally, nice push, and now we are really getting close to our target. The target was set to be the second line of our speed bump, which is slightly above 65. We are currently trading at 64.08, so there is a little bit more to go to get to this target. Now, climate is doing exactly the same thing as the S&P. So we are dealing with 6 out of 5. Okay. Now, the one thing which is cool is that while the S&P is totally overextended, the 2 standard deviation max distance for the stock is 130, and that stock has proven has shown strength up to 0.97 on this way up. Okay, that was the time when we got 0.97. That was this particular candle right here. Okay, and that move, while it was a nice one, does not surpass the 2 standard deviation, which is 130. That was only 0.97. So in other words, this market is not as tired, if you wish, statistically speaking, as the S&P. We also have buyers above calls above the puts, so we have buyers in the market, and therefore, I am not that concerned about this trade to go south. Remember as well that this particular stock belongs to a sector which is showing strength. Okay, so this belongs to semiconductors, and semiconductors were gaining a little bit of strength. This is the long term. If I show the midterm of semiconductors, if you recall, we took this trade because we had done a sector rotation a few days ago only. Okay, so that rotation took place. We filtered for 5 days or less. Okay, so you can see how that sector rotation took place. The sector kept pushing, and the stock, basically went with it, which is something that we expect, which is why we filter for stocks this way. So all is working according to plan. The only concern I have here, which is not a major concern, is what if the S&P really gets very negative, right? So what if the S&P really crashes hard? So then that stock is gonna basically go against us, because stocks are a fragile asset. They depend on many things, depend on competitors, on sectors, on the S&P, etc. So that's my only concern. My concern is on the stock. Is really the market environment with so many things happening out there, including fundamentals. Some of them, if I could use the term, informal term, some of the fundamentals, some of them sillier than others, with all respect for certain fundamentals. And if you know what I mean, I'm talking about certain trips to certain countries in Asia. If you know what I mean, I don't even know why this is a news, but anyway. But if the market's gonna react to it, so next thing we may be at risk. Okay, so that's my only concern. So I would like to examine this position from the point of view of exploring opportunities to mitigate my risk if that was to be the case. Okay, so here is Micron. Okay, and by the way, I didn't remove Twitter. Twitter is over, so let me delete. We don't need any of this. Here we go. We're just working with Micron. So here we go. So here is Micron, right? And again, we are in this position. We have time decay in our favor. There is so much more money to be made on this trade as time passes. So it's all working fine. But again, if it goes back down, right? If it goes below this price point, which is around 61 or something like that, so now we get into the red territory and it gets worse. So what can we do here? Can we do something to this trade? So if something happens in the broad market and Micron suffers and drops, also Micron is a technology-related company, so you understand why I was talking about a trip to Asia, I guess, because that country produces a lot of chips, right? So if something was to happen to Micron, next thing you know, we're gonna be in trouble. So what can we do, right? So let's click on the compare spread functionality and copy the primary spread. So now we got the same trade in orange color instead of blue. Another question is, what can we do to this trade? Okay, so first, just to be visual, the trade that we have currently is made of selling the 62.5 put and buying below the 60 put. Okay, so this is the trade that we have. Okay, it's a bull put spread, which we took slightly in the money, so it was a bit directional. Okay, it was a bit directional, giving us that break-even point of 61.40, where as long as we are above 61.40 on expiration, we're gonna be okay. We are currently trading at 64, so really the trade looks nice. Again, I don't have that major concern, as I'm repeating myself. Okay, but again, can we do something to this bull put spread? So if the stock was to fall, we don't get into this decline of profitability into the red territory. Okay, what can we do? Well, many of the cases where we are trying to massage a trade and find a better outcome imply some sort of a butterflying effect, right? So what I'm going to do here is I'm going to edit the spread to add two more legs. Okay, the two legs I'm going to use with a midpoint are going to be the two legs that I would potentially add to the trade if what I conclude is good for us. Again, when you do this analysis of what I often call tweaks or massaging the trade, when you do this type of analysis, we need to add, apart from our trading rules, we need to add common sense. Sometimes you analyze what would happen to a trade if you tweak it, and then the result is like, it's kind of almost the same. It doesn't make a difference. So then we don't do it, right? So that's when we use common sense. So let's explore a few possibilities, right? So what if I was to go ahead and let me put it here, and then you see what I'm doing. So what if I was to go ahead and on top of my 62.5 puts, which I purchased the 60 and I sold the 62.5. So what if I sell another 62.5? Is also sell, right? And then I buy a 65 put on top of the whole thing. So if I was to write this down, it would look like that. Buy the 65, sell 2 of the 62.5, and buy the 60 put, which this, my friends, is a put butterfly, isn't it? Okay, this is a put butterfly. So we could certainly explore what if we do a put butterfly. Is that going to help the trade? Is not going to help the trade? What would the outcome be? I mean, before I click on OK, think about it. If I am butterflying the trade, I am basically adding more premium in. And if I'm going to be adding more premium in, probably I'm going to reduce the risk of the trade, ideally make it positive or zero, and then give the trade another chance to make a profit, ideally better. But also, if the trade goes against us, then reduce the risk, ideally eliminate the risk completely. That's the intention. Okay, so let's see if we accomplish that with butterflying. I'm going to click OK. And now we can see how we can compare the blue graph with the orange graph, being the blue graph, the trade that we have currently running, and being the orange graph, the new trade that we will have in place. Well, the good news here is that we now reduce the risk from $100, $40 risk per contract in the blue trade, which is the trade we have currently. The risk would now be reduced to $3.50. So there will still be risk, but the risk is only $3.50. Notice how the orange line goes below the zero line by only $3.50. So that's okay. Okay, we are reducing a lot of the risk. Okay, but I'm not too happy about the fact that if the stock keeps going higher and reaches our target at 65, okay, so instead of making money, I am giving up. If you see the orange line is going down, so I'm giving up a little bit of the profit I currently have if I reach my target at 65. Okay, I don't know if I place the line in the right place. Oh, sorry, 65 is more like here. Here we go. I'm like, that doesn't make sense. Okay, so here is 65. So still we have a little bit of a slowdown effect there. So, again, if I'm gonna end up with the same profit when I reach my target versus what I have now, what about I just close it now? And that's it. Okay, so that's one option to put on the table and to consider. Now, the real problem, though, is that if the stock was to keep going and going and going, actually, I'm going to lose even more and more and more. Worst case, if this is happening much later, close to the expiration date, actually, the stock may go higher. Let's say the stock goes all the way to 75, which is a very, very nice, powerful move to the upside. And guess what? Now I just lost 3.5 instead of making my $110 of credit. Now I lost 3.5. So I'm not very happy to have this butterfly so near to the break even, because basically it's only giving me the possibility to make money if the stock was to actually go back down and find the midpoint of the butterfly, which is my strike 62.5. In other words, I would now be betting on a move to the downside. So not happy about that. Okay, so what else can we do? Can we maybe, and again, many of the times when we do this analysis, okay, it's because, we've seen it so many times, right? It's extremely useful to work on massaging those trades. But we also seen many times that after we do the analysis, we decide we're not going to do it. That could also happen. So, for example, for this butterfly, I would not do it. I would just rather close the trade and that's it. Okay. And if I'm going to close the trade and that's it, since the delta is quite reduced, which is only 10 delta, I would prefer to do this manually instead of doing it today. Just wait and watch the stock manually. And if the stock is going down, especially if we have UFOs on the chart like we do, and price goes down and breaks one or two of those UFOs, now you would be like, okay, wait a moment, this is serious now. It's going down big time. So maybe you want to close the trade manually, and instead of making $26 per contract, maybe you made, I don't know, $15 per contract. It would be a poor trade, but it would be a good management. Okay, poor trade from the point of view that it's not like you made anything close to the $110 of credit collected. You would have made only, let's say, $15. So it would be quite poor, but it would be a proper management. Okay, so from that angle, I'd be happy to handle the situation in this way. No, not a problem. Okay, but again, let's try to find a better way, right? And to me, a better way maybe would be to maybe try to open up a little bit of profitability to the upside. And for that, maybe what I could do is to move the strike I was going to sell at 62.5, move it higher at 65. And then the strikes I was going to buy at 65 needs to be moved higher at 67.5. If I do that, this is going to be an Iron Condor. Okay, you can see it here. That's an Iron Condor. So what did I accomplish now? Well, what I have accomplished is that now the rate of dying decay is going to be accelerated. It's going to be better because now the total amount of credit collected now, it's all the way up to $215. So I'm doubling the potential for profit of this trade. Depending on how long it's going to stay there, I'm going to have a greater level of time decay. And if it goes against me, so now the most I can lose is $35, okay, which is much less than 140. So I'm reducing the risk significantly. And worst case, my loss will be limited to $35, which is extremely little. Okay, so this action to me, it's smarter compared to the butterfly, which was not giving us enough. Okay, of course, if you do the butterfly and the stock had been a bit higher, then the butterfly may be a good choice. It just happens to be that we are just a bit too far from that target at 65 point something. and because of that, the butterfly was not too pretty. Okay, so this one, you know what, I'm okay to consider it. So I'm gonna leave it there, and I'm gonna copy the primary spread again, and I, give it a try for another tweak and see what happens if instead of doing 65, 67 and a half, which is what I done before, what if I do 65, 70? Okay, what if I do 65, 70? Okay, what is going to happen now? Because this is now going to be a broken wing iron butterfly. So what's going to happen if I do that? I didn't do this right. Sorry, I kept the word sell. It needs to be buy. Okay, yes, sell buy. Yes, now I have it right. So by doing that, notice what happens now. So I have created a greater level of profit for the trade. And now if the stock goes down, no matter how much it goes down, I profit. But now if the stock goes up, I have a loss which surpasses my original loss. Okay, and this is something I never want to do. So if I'm going to do a tweak and my loss surpasses what I was risking at the beginning, I'm just not doing it. I mean, these are rules in my trading plan. Some of you may have a different rule, may be a bit more tolerant with risk, may take trades with less risk, opening the door to take more risk during the trade. Nothing wrong, nothing right in trading. It's all about your trading plan. It's all about your trading psychology, trading personality, trading style, etc. I'm just sharing what I do. I just don't do it. If I massage a trade, is to remove pain, is not to add pain. So I always like to see that risk diminish, which is not the case. So certainly this trade is not a trade I would accept. Now, if we had something like that, right, where the risk was, let's say, $50. So if the stock goes higher and surpasses this value, which is, let's say, 68, knowing that I'm going to take profit, somewhere in here. Sorry for that, guys. I just hit the wrong keyboard combination. And I believe I just created a little bit of a conflict there with my drawing tool. And let me see. Okay, no, I didn't create any conflict. Sorry for that. So what I was going to say is that because I'm planning to take profit somewhere here, so it all depends on how long it's going to take for me to get there. The more it takes for me to get there, the closer to this size of a profit I'm going to be. The less long it takes, the closer to the bottom part of the profit I'm going to be. Okay, but as long as I'm taking profit here, I don't really mind too much that there is risk at higher price levels because I have a target which I'm going to use to exit. So I don't mind too much that there is risk on the upper part. So going back to the Iron Condor, which technically is a long put condor because it's an Iron Condor made of puts only. There is no puts and calls, so I cannot call it iron, to be honest. So when you look at the long put condor, notice that the level of risk above is very limited. Okay, and again, if I'm taking profit somewhere here in the middle, so I'm giving myself the chance to make more depending on how long it's going to take based on the time decay. So I'm okay with that. Okay, the problem here is that when I did the broken wing condor, so that risk went so much lower, surpassing my initial 140 and becoming 200 plus. And that is something that I'm not going to accept. So I'm going to do one last try to conclude what do we do here, which is instead of doing the broken wing iron condor, or let me rephrase it again, the broken wing put condor, so much muscle memory. So what we could do is broken wing put butterfly, which is then I'm going to use the 62.5 strike again. And from 62.5, I'm going to go to 67.5. So I got $5 on the top, $2.50 on the bottom. And that's a butterfly because it uses the same 62.5 is the same strike. The ones that are short are 2 strikes, are 2 units. Sorry for that. And when I do that, you can see I got a similar setup. Okay. But now, notice how my risk is also increased only by $5, but it goes from 140 to 145. So again, it's not really providing what I want. So in other words, the best way in my mind to, when I say my mind, I mean based on my trading plan and my trading preferences, which obviously are in my trading plan. So the best way to approach this trade is either to do nothing if you want to keep it real simple, or convert it into an iron condor by adding the 65 and the 67 and a half strikes. So you can be in there. Now, if you do this, you have to manage this as an iron condor, okay? Because if the stock keeps going higher, then you're going to start losing money, right? And therefore, you have to exit before that happens. So right now, if the stock goes higher all the way to this price point is 66.73, you're going to make more or less the same amount of money we're making now, which is 26 bucks. You're going to make about the same. But if it goes higher, now you start losing, right? So again, this is something for you to manage manually, so you don't get into a problematic situation where you were in a nice profit, the stock is moving higher, and now you're losing, okay? So in my case, because we are meeting only once a week, and I'm not going to be able to manage this trade with you guys. I mean, I could manage it myself, but the purpose of these sessions is for you, not for me. So then I'm just going to leave it the way it is, and I'm just going to do nothing to the trade, just leave it like that as a credit spread. And after the whole conversation, I decided I'm not going to do anything. But for the ones of you that are more active and you're going to be managing this trade, a very good choice based on my trading preferences, my trading plan, would be to add the 65 put short, the 67 and a half put long, and therefore convert this credit spread into a put condor, where the risk would now be diminished to $32.50, and now you could make up to 217 instead of the initial 110. Okay, so this would be what we do. And the iron butterfly, meaning combining the calls and the puts, it will not really improve it. You could give it a try, Mark. Sometimes certain calls got a little bit more premium than certain puts. But again, because we are buying one, selling one, if there is a difference, it's going to be very minor, unless there is some very relevant price anomaly, which rarely happens, but it could happen. So it's worth it to try. I won't do it, just to save a bit of time for other trades, but it's worth it to try, even though I would guess that you're going to end up with the same thing. Okay, so also to avoid errors with executions and things of this sort, which is also something that has value. So keeping it all as puts could be a valid way to approach it, to keep the trade a bit simpler instead of combining calls and puts. It's all puts, so you just focus on the strike prices and you make no mistake with the execution. Anyway, long conversation here, guys, but again, we all know the importance of trade management. Sometimes it's even more important than getting into a good trade. Of course, if you get into a good, easy trade is great, but sometimes we don't get a good trade, or the trade is not easy, and the trade management is the key. Okay, so I often spend a long time discussing this, but hopefully you guys are also putting some practice in. Okay, comment from Joe there. With a lot of time left to expiry and price grinding up, what about adding a call calendar up above? Well, doing a call calendar up above is exactly the same as doing a put spread up above. It's exactly the same. Again, and I know this could sound weird, and I just told Mark a moment ago I'm not going to do the butterfly, but I sense that there may be, because the iron butterfly means that you combine calls and puts, which is in a way what you're suggesting, Joe, even though you suggest doing a call credit, a bear call spread, meaning that you are converting it into an iron condor, but you will see the risk profile is going to be the same. Let me do it so you see it. So I'm just going to add two legs. I'm going to make them mid-mid, but now instead of put, I'm going to make them call. And then we're going to have sell and buy. And if I do 65 for the one I sell and 67.5 for the one I buy, okay, 1, 2, 3, you're going to get the same risk profile. Here we go. You got it. Okay. The risk is 34 instead of 32.5. It seems that with the puts, it was a little better. Sorry, guys. But it's about the same as you can see, which is the point I was bringing in for Mark. Okay, and I know it feels weird. At least that's how it felt for me when I started learning to trade options years ago. And it's like, how can it be possible that with the calls it's the same as with the puts, right? Well, it's the same. When you look at the risk profile of a bull call spread, isn't it the same as the risk profile of a bull put spread? Isn't it the same risk profile? So if you think about it, it makes a lot of sense, even though it's often very confusing, right? Because you are thinking the stock is going up, so what about I sell a bear call higher? That makes a lot of sense. That's a lot of common sense. But at the same time, which is less intuitive, but it makes sense too, is the same as doing a bear put. Because if the bull call spread risk graph is the same as the bull put, then the bear put spread risk graph is the same as the bear call. Hopefully, I didn't drive you crazy by saying it so fast, but we now need to move into planning for trades. Okay. Um, Good conversation, guys. Okay, and how is it going? Give me some feedback there. So again, I'm gonna leave the trade the way it is. Just in case, I'm gonna zoom in here in case anyone wants to take a screenshot. In case you wanna, maybe if you are executing that in a demo account, for example, for practice purposes or any purpose on your end, just so you have these 2 units in the bottom part are the 2 units to be added to convert the trade into a long put condor, which has the same risk profile of an iron condor, which is why I was calling it an iron condor earlier, even though it's made of puts. Anyway, let's keep going. Guys, if all is good, I would certainly appreciate a quick all okay on the chat box. Okay, so I know you guys are okay. You probably are, but it really helps me, guys, when you guys get back to me with a little bit of feedback. So what are we looking for? Okay, so we are looking for non-directional trades with low volatility conditions. So we're going to be looking at all sort of stocks, okay, not necessarily stocks that belong to any industry. We're going to be looking at stocks that are in the penny increment options list. The MU target mark is 65.3. Okay, 65.3. Nice. Thank you so much for that, Ahmed, Anil, Jeff. This is very appreciated. Thanks a lot, guys. So we got the penny increment options list. Now we are looking for non-directional. So I want the strength to be neutral in the daily time frame. I also want the strength to be neutral in the weekly time frame. For earnings, we'll want the earnings to be a bit far. Okay, so exclude anything with earnings in 30 days or less. And finally, auto climate, we are not going to need it because we are not looking for a directional move. So I will uncheck auto climate. And then here, going back to the top filtering conditions, what we need is cheap options. So I'm going to start in a very demanding mode, as always, looking for CIV mean less than 20. And I may get a few, I got more than what I thought. Okay, so it does mean that the VIX is quite low, to be honest. So here we go. So we have a few of these trades that could be good candidates. Reporting earnings on October 19, September 22, September 14, November 1st, October 20 something. So so based on dates, I would prefer GameStop. Okay, based on dates, but GameStop is a stock which is currently trading at $38, and often you don't get too much meat from a point of view of a premium received for the options that we're gonna sell. I mean, we're gonna get limited meat because implied volatility is low anyway. But on top of that, if the stock is $38, it's gonna pay us less. So I think that FedEx is gonna be my choice, a $200+ stock. And for Popular, INC, I will certainly take a look at those options, but I believe they are not that liquid, so I may pass. So later I'll do some additional analysis, if FedEx is not our choice. So let's look at FedEx, okay? Let's begin our analysis looking at FedEx. So what do we have? We have a statistical range for FedEx, which based on historical volatility could be quite wide. But based on implied volatility, you can see the implied volatility, the red line, is between the blue. In other words, the implied volatility is low compared to what the historical volatility suggests. So now, 9/23 is the expiration date that is coming right after earnings. Okay, earnings are set to be on September 22nd, and the expiration date is September 23. So that's pretty good. That's pretty good. Okay. So we're gonna be focusing on that one. And if we were to take this trade, so then the trade plan would be as follows. We'll be looking at the top part of the range to be the top part of our cone. We'll be looking at the bottom part of the range to be the bottom part of our cone right here. And then what we want to do is that we want to take this very large zone and we want to break it down in three parts. So calculator is needed for that. So we are talking about 283.64, right? And the bottom part is 187.18. We don't need to be that precise for this, okay? So that's a $96 range. We're gonna divide this by 3, and that's giving us pieces of 32. So if I start from the bottom, so 187.18 plus 32, that is 219. That's gonna be 220, okay? So 220, we're gonna have a purple line there at 220. There we go. Okay, this is a purple line. And on the upper part, so we're gonna do the same. So we have the top part there is 283.96, more or less. Again, we don't need to be that precise. Minus 32, which is a third of the range, is 251. So I'm gonna call it 250. So we are talking about 250 and 220. Okay. So what do we want to do at those levels? What we want to do at those levels is we're constructing our double calendar, isn't it? So we want to buy a call, okay, using that September 23 expiration, and we also want to sell a call. And of course, the strikes to be selected will be 250 and 250 for the call side, and the call that we sell is going to use weekly options. Okay, so that's going to be your call calendar, okay, which we're going to place right here, and we're going to do the same on the bottom part with puts, where we're going to be utilizing the 220 put, utilizing September 23, and we're going to be selling the 220 put using weeklies. Okay, this is the plan for the trade. So let's go ahead and take a look at what this would look like, because notice I said weekly, but I left weekly open. So let's look at a little bit about what type of skew we get in this particular case with that particular stock. So I'm looking at 9 strikes, and I'm loading expiration date starting on next Friday, not tomorrow, the week after, which is August 12, all the way to September 23. So I'm loading all the colors to see. So far, August 12, which is the red color, is the one on top of everything. So definitely it provides the greatest level of volatility, and the other ones are so much lower that it doesn't even make sense to spend time looking at it. It's pretty clear that selling the front week is the right thing to do, is the most efficient thing to do. It's almost always the case, but sometimes it's not. That's why I'm checking. Okay, so we're gonna be when it comes to that weekly, okay, that weekly expiration date, it's going to be August 12th. Okay, this is what we're gonna do as we are building the trade. Of course, later on, when we work with this trade every week, as the trade progresses towards September 23 expiration, we're gonna have to do other things, right? We're gonna have to be rolling, and finally, the very last week, we will then convert this double calendar into a double diagonal. Okay, but that will be the last week. So far, it's gonna be a double calendar during its whole life. Okay. Oh, good point, Anil. Good catch. Good catch. You're absolutely right. I didn't have the symbol change. Let me take a look at this again. Let me see. I love it. So here we go. We can see, to be honest, we can see a little bit more equality here with the orange one, which orange happens to be September 23. Interesting. What about the put side? calls and puts. Wow, the put side got plenty of premium, and that's the one we're gonna buy. My friends, thank you very much, Anil. I just invalidated this trade. We are not gonna do this trade. Again, let me explain why. If you are thinking, why would you do that, Jose? Well, look, we're gonna be buying the September 23, which is the orange color, and we're gonna be selling the August 12, which is the red color. And notice what's happening to the implied volatilities, right? I mean, on the call side is more or less okay, but with the put side, based on what I saw, look at how many strikes are cheaper on the put side compared to using August 12 compared to using September 23. In other words, you may have heard me use the term, which is incorrect, but many times I use the term looking for an arbitrage opportunity, where you want the front week to have a higher level of implied volatility than the long term. So when you sell those options, you get paid less because there is less time to expiration, but in a proportion, as a proportion, you get paid more because you got so much more implied volatility. That was the case with Micron. Okay, just to illustrate my point here. So when looking at Micron, so you can see how the red is clearly above the orange all the time, no matter the strike. So I was very happy, but I had the wrong symbol. So Anil, thank you for that. We are humans after all, and we indeed make mistakes. So anyway, so let's go back to the matrix and find other opportunities. So in here, I could also be looking at, I mean, I would prefer to pass on Pfizer and Twitter because again, they are $49 stocks. So I would prefer a little bit more juice. And BPOP is probably not that liquid. So what I'm going to do is I'm going to move to a different way on how to look at cheap options, which is instead of looking at implied volatility mean less than 20, I'm going to look at CIV mean minus historic below 2 standard deviation and see if we got more symbols. We have GILD. That's a $62 stock. So let's take a look. Yeah, this I'm not happy about this. Okay, because while it shows on the scanner based on the filtering conditions that we added, which is what it is, on the chart with the settings I have on the probability cone, which in case you have forgotten, the probability cone is looking at 1 month, which is 21 days, 2 months, which is 42 days, and 3 months, 63 days historical volatility. So based on the historical volatility of the 1, 2, and 3 last months, these options are actually expensive. The red line is beyond the blue lines. So not happy about that. And therefore, I'm going to go back to the matrix and look for another way to look at cheap options, which is to look at options that have experienced the greatest decrease in the CIV mean in the last 5 days as a percentage. So when looking at that, let's see what we get. We also get MedLife, which is also a $60+ stock that was not there before. So let's go take a look at MedLife. We have the same situation. So I'm not happy about this. Okay, so I'm going to go back to my first initial filtering condition, and it seems that I'm going to have to build this trade with a little bit cheaper stocks. It's not what I like the most, but that's what the market has to give us now. You may rescan a few hours later and it's different, but right now it's what it is. Okay, so back to the screener. So we got 41.49 is Pfizer. So let's take a look at Pfizer. Earning dates November 1st. That's very far. Okay, so yeah, the red line is between the blue, but quite far away. Let me see if I can get something better with Twitter. And we just did a double calendar with Twitter that didn't work, by the way, but we could blame Mr. Elon Musk for that. Because the whole peak of volatility took place way before earnings because of what was said about the deal with Twitter and that then was rejected and all of that. So, but anyway, we are now in a very favorable situation to do it again, because notice here, this is exactly what I like the most, which is where the red line is way clearly inside all the blue lines, right? So now the implied volatility is clearly cheaper than what the stock is capable of doing. Okay, so let's reassess that from that angle, and let's plan on the trade. We're gonna have to use November expiration. Yes, I'm not happy about these guys. Not happy about this. I need an expiration date there right after earnings. This one is too far, and because Twitter is so liquid, as dates are approaching, new expiration dates will be released, new cycles will be released by the exchanges, and therefore this November expiration date will not benefit from the increase of implied volatility as we are approaching earnings. So, wow, yeah, I'm really not happy about this. So, what about BPOP? Here, my concern really, we're not going to do it. We only got monthlies. I was going to talk about my concern related to liquidity. We only got monthlies, which basically tells you that it's not that liquid. So let me go back to the list and recheck. And I didn't miss anything. No, I did not. Okay. So what can you do in a situation like that? Okay, so you could look for neutrality instead of daily to weekly. You can look for neutrality for 2 days to weekly, and this may give you more symbols. Here we go. So now you have a wider list. Okay, so again, I always go with, when it comes to filtering for opportunities, I always go from the most extreme, and little by little I become more tolerant or more flexible, in order to find my opportunities if I need to find them. Okay, maybe your account is loaded with trades and you don't need to add them, so then you wait for the next day. But if, let's say, you need a trade because some trades you just close them, either for a profit or a loss, but those trades are not in your account anymore, and you need to add more positions to balance out the Greeks of your portfolio. So then that's what you do to find opportunities. You give yourself a little bit more flexibility. Okay, so what do we have here? Okay, let me take a look. So we have ATVI, $80 stock, November 1st, October, September 14. Okay. Okay, what about we take a look at Nucor? Okay, so yes, perfect. That's what I thought. So we got earnings on October 20. Sorry, yes, October 20, and expiration date October 21st. This is what I like the most. Okay, and also nice. The red line is nicely inside the blue lines. Okay, so this type of setup, happy with it. Stock is $100+ per share. We should get more or less okay premium for that, and therefore it's time to set the range. Oh, sorry for that. Let me do this again. I'm looking at the time. We got 7 minutes to go. We can do it, guys. 7 minutes. Let's do it. Here we go. So here's the range. Let's bring in the calculator. So we are talking about 175.06 minus 98.17 divided by 3. That's $25. $25 plus 98.17. That is 123.8. Okay, 123.8. So let's take a look at the chain for this one. $1 strike price increments in the longer expiration date. So this one was October. So let's take a look at October. This is where I'm concerned the most, because we will have probably less strikes in October. There are $5. So okay, so $5. So if the calculator say 123, that's gonna become 125. Okay, because I need to align myself with the $5 price increments. So this is where we're gonna be. Good enough. And then on the upper part, so we are looking at 175 minus 25, so that's going to be 150. So 150 is here. Okay, good enough. And again, the plan is the same as we said before. Okay, so we're gonna be looking at buying the calls and the puts using the September 23 expiration and selling the weeklies. So let's take a look at the skew starting from September 23. And September is orange color, and we can see that orange color is clearly very much way below the red line for many strikes. Okay, let me add a few more strikes. 9. Okay, is good, and we can even look at calls and puts both. And yeah, it is indeed looking like the orange is clearly below the red. Okay, so the red being the front wick and the orange being September 23. So here we have that arbitrage opportunity I was talking about, which again is a totally incorrect term, but you get my point, where we are buying 40 something volatility and we are selling 45, 46 volatilities. Okay, so we have this differential percentage of volatilities, which it's indeed what we're looking for. So we're going to be looking at August 12th, October 21st. We are only interested in very specific strikes. So I'm going to select 3 strikes, align with the 125 and align with the 150. Okay, so those are the ones that we need to care about. So using October 21st expiration, we're going to be buying the 150 call, okay, and selling the 150 call using the front wick. And on the put side, we're going to be selling the 125 put, and we're going to be buying the 125 put. Okay, now this is the trade. Okay, because the expiration is October, this trade ends up being a little bit high risk. So I guess it's not super ideal if you are a brand new trader with options. Probably better to use it in a demo account if you want to keep the practice, but risking $1,000 is too much. So so then you may want to keep this in a demo account. Okay, but basically this trade shows a P&L, a premium to be paid of net $10.77 of debit times 100. That is $1,077 of maximum loss. The most you can lose is what you pay for it, which is $1,077. Okay, that's why I mentioned it's a little bit high risk. We are not looking at September mark, we're looking at October. Okay, October, not September. So yeah, so trade is good. As every week takes place, and from now until October 21st, there are many weeks. Did I say September before? It's October 21st. Okay, you can see here. If I said September, maybe it was muscle memory from the prior trade. Sorry about that, but it's October 21st, okay, which is what I got on the screen, okay, right here. I got October 21st and October 21st. Okay, cool. So again, the way this trade is going to work as we are approaching earnings is that we're going to be we're going to be rolling to the next week and next week and next week. And therefore, this initial $1,000+ of risk will be diminished. And because volatility is very low and because we are going to be approaching earnings, which is going to take a while, but we will. So volatility will rise. And as this happens, now we are making a big, large zone, which is green color zone, meaning profitable. That's what we are pursuing. We're pursuing to catching the rise of volatility while we capture time decay as we are rolling this trade every week. Okay, so the trade is valid. Again, the only problem with the trade, if you wish, is the fact that it carries a risk, which, again, depending on your account size, it may be okay. But I'm always putting myself in the shoes of a new trader learning options for the first time. So this may be a bit too much, I would say, for an average trader learning options at the beginning. And therefore, a demo account may be ideal if you want to practice the trade. If this risk is fine and $1,000 is okay for your risk appetite, so then you could also consider obviously executing this trade in a real account. All of those are, as you know, your choices, and just giving you the pros and the cons. Okay, so let's put the trade in place. I'm gonna bring in TOS, we're gonna load new core. We're gonna look at October expiration with the 150 strike buy and the 125 strike buy, and then we are looking at the front week, which is August 12th, where we are gonna be buying the 150 strike. It's not there. Okay, I need to load the list. Let me do this. I'm just gonna add any call, any put, and by the way, I did buy instead of sell. Silly me. Okay, sell. So the one we're gonna sell is the 150 call, and the one we're gonna sell is the 125 put. Okay, so if we do this, we end up with our $1,000+ of debit. Okay, again, using August 12th, we are selling. Okay, and using October 21st, we are buying the call and the put. So the trade is valid. I'm just gonna place it, see if I get filled. And if I don't get filled, I'll just push it with a market order because we already surpassed the time and I just want to have it in. Even though, please never do that. I say that in multiple occasions. Never do what I'm doing now, which is converting a limit order into a market order. Especially in a 4-leg trade, you may get massive slippage. So never do that. Negotiate your entries. I'm just doing it because the session should be over. So I'm just want to get it executed like we just did, 1078 in the simulator. So I can have these figures reported inside top so we can track the trade from now until October 21st. We'll have a lot of work to do with this trade. It's going to be a great learning experience for the ones of you who have never done a double calendar trade. Okay, so what are my fill prices? I'm just going to document this. My fill prices have been 526.45, 520, and 645 on the ones we bought, and 18 cents and 69. Here we go. So I'm gonna click OK. So this is the trade we got, and I'm just gonna copy this to the clipboard so I can have it saved for future review. So here is our new core trade, and we'll be working on that as we've done many other times. The last thing for me to do before I say bye is just to draw a line here so we know exactly when we enter the trade where was the stock, so we can comment on all of this in future sessions. Okay, so we're done, my friends. Comments on the chat box. Any feedback? If you have any questions about the trade, for sure, ask me so I can clarify before we are done. If you have any positive or not so positive comment to share, any feedback, as long as it's constructive, I'll be more than happy to take it. Let me know on the chat box so I know how to make this better every time for you guys in future sessions. And if there is nothing, so then I will just say goodbye. But again, just waiting. There is a little bit of video delay every time as we're streaming, so I'll just wait a few seconds to get your responses there. It's been a pleasure. And Anil, I believe this is the first session that you are joining us, isn't it? I believe, if I'm not mistaken. You may be watching videos on YouTube, maybe, but I believe it is the first time you are joining us live. Please correct me if I'm wrong, and if I'm wrong, I apologize. But I believe this will be the case. And the reason why I'm asking as well is so I can say, yes, exactly. So I was right. So I just want to say welcome, my friend. Okay, it's a pleasure to have you. Yeah. Very good. Sunday. Do we have a session on Sunday? To be honest, I don't know by heart. But I am about to confirm if we do. I would think so. So Sunday will be the 7th, right? Yes, correct. Yes, we do have a live session on Sunday. Okay. So on Sunday we have a top session. So we'll be talking about the platform. Yes. Joe, see you then. And everyone, again, a pleasure. Thank you, guys, and see you in the next one. Trade well, my friends. Be safe, and anything you need, contact us. We're here to help. Bye bye, everyone. Take care.